Hi dear students, welcome to the YouTube live for quick revisions of some important topics as has been asked by a lot of students, right? We'll be largely covering inventory, joint life policy, and then if time permits, we'll take up other courses. If you're able to see my screen, just hit the like button so that, I get to know, or you can just drop a comment that, you are able to see my screen. Right, this is the last minute revision of some important topics as asked by the students. If you have any questions related to topics that we are discussing today, you can drop a comment and I'll be happy to address them as we move along. I'll not be getting into too much of, I'm not be able to, spending too much of time as far as the detailed theory is concerned, but still we'll have a brief about theory and then we'll move to the specific adjustments that students find difficult. Now, talking about inventories, whenever we talk about inventories, we have three parts to it. One is finished goods. Now, these are the goods which are to be sold in the ordinary course of business. Only then we call it inventory. Then, just a moment, guys. I think you guys are not able to see me. I'll just start my video. Yeah, I hope now you'll be able to see me. So, finished goods which are for the purpose of sale. That's the first part. Then we have work in process, which will be in the process, and after they are produced, you will be selling them out. And then you have raw materials, right? Now, these are the three components of inventory, which is broadly defined by accounting standard 2. Now, when it comes to valuation of inventory, the simple principle is lower of cost or NRV. Cost or NRV, whichever is lower. Now, why do we do this? Purely based on the principle of prudence, or you call it conservatism. Based on these two principles, we value it at lower of cost or net realizable value. Now, whenever we talk about cost, cost has the component of cost of purchase, cost of conversion, and other cost. Now, whenever we say cost of purchase, always remember all the costs which are necessary to bring the inventory to the current condition and the current location, they are included. For example, freight, transportation, insurance cost incurred to bring the goods from the supplier place to our warehouses, any other cost, loading cost, unloading cost, till the time the goods reach our warehouse, all those costs will be included. Cost incurred after that, after the goods reach our warehouse, any cost if you incur, those costs will be excluded. For example, what will not be included? Storage cost. Why? Because these are the costs after the goods have reached your warehouse. Then you will not include any selling cost. Why? Because these are the costs related to sales and not related to purchases. Any item of abnormal loss, right? We discussed about abnormal loss in the previous session also in consignment. If it is an item of abnormal loss, you will not include. And if it is any administrative related cost, even these costs you will not include. So by computing these three, cost of purchases, your purchase cost, and if at all there is any discount, you will reduce the discount. If you pay tax, and if that tax is available as a benefit, for example, when you pay GST, you can take input tax credit. Now, if you can take input tax credit, if you get a benefit of the tax paid, that cost you will not include. So, for taxes, if benefit is available, then you will not include. If no benefit is available, if you do not get any benefit, then you will include. For example, when you pay customs duty, generally you do not get any benefit. If you import and when you pay customs duty, most of the times it is an expense. You will not get any benefit. You will not get any refund unless you meet certain export criteria and all of those things. So if there is no benefit, then you will include. If some benefit is there, if you get input credit, anyways, this is a slightly advanced concept at foundation level, but still, If you get any input credit, you will not include that. You will exclude the tax portion when you compute the cost of inventory. What are cost of conversion? Basically, cost to convert raw material to finished goods, your direct labor, the cost of factory overhead, all of those things you will include here, and any other cost which are incurred to bring the inventory to the current condition and current location, those costs you will be including, and other costs you will be excluding. Now that is about cost. Then we have NRV. Now what is this net realizable value? The estimated selling price minus any costs to be incurred for sale, or the third one is costs of completion. Now what does this mean? Let us say we have certain goods which are lying with us, which are still half completed, they are not yet fully completed, and we want to compute the NRV. First thing what we need to do is, what will be the estimated selling price of the finished product? So let us say estimated selling price comes to 1000. Then you have to see what is the cost that you will incur to complete the sale. Maybe you will incur some sales commission. Let us say sales commission of 5%. So you will pay 50 as sales commission. And then that product is not fully completed yet. You have to incur certain expenditure to complete that product. So let us say cost to complete is, say for example, 150. So 1000 minus 50 minus 150, what you get, 800 is NRV. That is a net realizable value. And let us say if the cost is 700, cost incurred so far is 700. How will you do? Whichever is lower, so 700 will be the valuation. If cost is 800, then 800 will be the valuation. If cost is 900, then also 800 will be the valuation. Whichever is lower, cost or net realizable value, whichever is lower, on that basis you will compute the inventory valuation. Now quickly we will run through the FIFO, LIFO, simple average and weighted average method, and then we will take up cases where you have to do certain adjustments to arrive at inventory. I think that is where a lot of students are facing challenge, and that is where we get a lot of questions on how do we do these kind of adjustments, right? But before that, we'll quickly go through what is FIFO, what is LIFO, and then what is a weighted average method. So 3 methods. FIFO. Now, what is FIFO? First in, first out. So what is the assumption? Whatever material comes in first, that material will go out first. Whatever material comes in next, when the first lot is exhausted, then the second lot will be used. For example, let us say we have different dates, we have quantity, we have rate, and then we have the value. Okay, so assume for a moment 1st of January of 20. Okay, we got 100 quantity, and let us say the rate is 50, the valuation is 5000. Then these are in. Okay, these are in. Then on, let us say 10th of January 20, you got another 50 units. Let us say at 60 per unit, this becomes 3000. Then we have to issue certain material. We are issuing certain material, let us say on 15th of January of 2020, where we say we issue 125 units. How many units? 125 units. Now, how do we get this, or what is the quantity to be allocated? For 125 units, first you will use this 100 units. So first issue will be, I'll just change the color, 100 units at 50. So first issue will be entire lot of first purchase, and balance 25 will come from this part. So 25 multiplied by 60, this will be 1500. Now what will be my closing inventory then? Closing inventory will come only from this particular lot. So first in, first out means whatever came in first will be issued first, and whatever is left in the inventory will be from the latest batch that has been received. So my closing inventory will always be from the latest batch, that is 25 units which is left out multiplied by 60, which is 1500. This is what we do when we do FIFO method of valuation. Now, in the same case, if you do LIFO, under LIFO, if we follow, whenever we issue on 15th of January 20, whatever came in last will be issued first. So what came in last? This 50 units came in last. So first you will issue these 50 units at a cost of 60. That becomes 3,000. And balance 75 will be issued from the initial lot, that is this lot. So 75 will be issued from there. 75 multiplied by 50. 75 multiplied by 50, that is 3750. Right? This is the issue. And what is the closing stock? Closing stock will be 25. Multiplied by 60, which is 25 multiplied by 50, which is 1250. So see, whenever in the examination, if you are asked to calculate the inventory under FIFO method or under the LIFO method, under FIFO method, take the latest one for closing inventory. Under the LIFO method, take the earliest one for the closing inventory. Now, what we'll also understand is, we have this formula which will be very useful not only at your foundation but also at your inter and final levels. Opening stock plus purchases plus direct expenses minus closing stock will give you cost of goods sold, COGS, which is nothing but cost of goods sold. Opening stock plus purchases plus any direct expenses minus the closing stock will give you cost of goods sold. Now, in the given case, if we follow FIFO method and if we follow LIFO method, what is the difference? Opening stock, in the both cases, it's nil. Purchases was 5,000 and 3,000. So purchases in both the cases is 8,000. Here also 8,000. No direct expenses for now. Closing stock. Under first case, closing stock was 1,500. Under second case, it is 1250. So 1,500, 1250. Now we can see the closing stock 6,500 here and 057. 6750 here. So 6,500 here and 6750 here. This is the difference when you use different method of inventory valuation. Here also you can cross check 3,000 plus 3,750. This was your COGS, which is 6,750. And here 5,000 plus 1,500, which is 6,500. Now, when it comes to weighted average, using the same example, 1st of January of 20, let us say 100 units at 55,000. Then on 10th of January of 20, let us say 50 units at 60, which has made it 3,000. Now, under weighted average, sorry, just a second. Under weighted average method, you will find out what is the weighted average cost per unit based on whatever has been received so far. So how will we compute the weighted average? 5,000 plus 3,000, 8,000, 100 plus 50, 150. So weighted average is 8,000 divided by 150, which comes to 53.33. Now, when you issue the goods, let's say you issued 125 units. Issued 125 units. This will be done at 53.33, which is 125 multiplied by 53.33. That gives us 6,666. So always remember, for weighted average, we will need to update the rate after every fresh input that we have got, or after every fresh inward that we have got. Now, after we have issued 125, how much is left? Out of 150, you issued 125. So 25 is left. 25 multiplied by 53.33. That comes to 133.33. 1333.25. So this I'll round it off to 7. Okay. So this, if we get fresh issue, let's say we got another in material, which is, let us say 50 units at 50 units at 50. Now how much is the thing? 2500. Now again you will compute a revised rate by considering these two. So 2500 plus 1333, 3833, and here you have 75 units. This was closing stock. 3833 divided by 75, that becomes 3833 divided by 75. This becomes 51.10. So like this, you will keep on updating the rate whenever we talk about weighted average costs. This was closing stock. 3833. Okay, so this is how we do. Now, the most trickiest part, that is, these are the simpler explanations and a quick revision of the logics that we need to understand. The trickiest part is where inventory is not held at the balance sheet date. So generally there is a concept called physical inventory verification. Physical inventory verification. Actually, most of the companies try to do a physical inventory verification by the year end. Most of the manufacturing and other companies, they try to do it at the end of the period. But what happens is, a lot of times you do not have time to take the inventory counting on the specific year end date. So for example, if the year end is on 31st March, you may not be able to calculate or do a physical verification of inventory on 31st March itself. In that case, you will do inventory verification either before 31st March or after 31st March. That is possible. So if I draw up a timeline, this is my year end, 31st of March. Inventory verification was not possible on this date. Okay, very good. If inventory verification was not possible on this date, then they would have done it either before or they will do it after. So maybe possible they did on 20th of March or they did on 15th of April. Now, if I do inventory verification on 15th of April and I get to know that my inventory is 50,000, my inventory is worth 50,000. Can I say on 31st March this is the same inventory? I cannot say that, because from 31st March to 15th of April, there would have been a lot of transactions. For example, some goods were purchased, right? Now, if some goods were purchased, what would happen to the inventory? From 31st March, if I have to compare, whenever there are fresh purchases, my inventory will go up. My inventory will go up. Then if there are certain sales, if I have made certain sales, then what would happen? My inventory will go down, right? Now, based on I hope the audio is clear now. Based on what is the transaction that's happening. If I purchased, my inventory would have gone up, and if I have sold, my inventory would have come down. Now, if I have to come back from 15th of April to 31st of March, then I'll have to just do the reverse. If I say my purchases has increased the inventory, this 50,000 includes purchases. Now, if I'm coming back, I will have to reduce my purchases. Second, because of sales, my inventory has come down, right? But I need to go back to 31st March. That means I have to increase my inventory. So any sales I have to increase. Now the question is, At what value should I do this adjustment? At what value should I do this adjustment? Purchases definitely at cost. For sales, also you need to find out what is the cost of goods. What is the cost of goods? And based on that, you have to work back. You cannot say that, for example, if I say 1000 is purchases and 1200 is sales, you can't say that 50,000 plus 1200 minus 1000. That is not the correct approach. 50,000, what is the cost here? You will add back that, and what is the cost here? You will reduce that to come back to 31st of March. Now, using the similar logic, if you have taken inventory on 20th March, now you want to reach to the inventory as on 31st of March, then what will we do? If any purchases are there, we will add. If any sales are there, we will reduce. If any purchases are there, we will add. If any sales are there, we will reduce, right? If you understand this logic, the adjustment of purchases and sales when inventory is taken at a very different date will be easier. Now, there could be some special cases. For example, you hold goods on consignment. The problem that you are solving, the person is a consignee. Now, we all know that inventory on consignment that we have is not our inventory. It is the inventory of the consignor. So that part you have to exclude. Sometimes what happens is goods are sent on sale or return basis, or goods are sent on sale or approval basis, right? Now, in this case, how do we handle that? If goods are unsold, right, and the time limit is still there. For example, you sent 10,000 worth of goods. We'll come to the calculation of cost and all. You sent goods worth of 10,000, and let us say 50% are unsold. 50% are unsold. What will you do? To the extent of 50%, you will add it to your inventory. You will add it to your inventory. But you will consider only the cost of these goods. You will only consider the cost of these goods. Now, how do we compute the cost? It's very simple. We need to know what is the gross profit margin. What is the gross profit margin? What is the formula for that? Gross profit by sales multiplied by 100. Either this margin or this gross profit ratio will be given to you in the question. If it is not given to you in the question, then you have to compute both of these and then figure out what is the gross profit margin. Now, whenever we are computing gross profit margin, whenever we are doing inventory related adjustment, please note that any abnormal items will be excluded to compute this GP margin or the gross profit margin. For example, if there was a write down on inventory in the previous period, that part you will exclude both from the stock and from the sales, and then compute the gross profit margin or the gross profit amount. I hope this is clear. Now, what we will do is, we will take up a question from your RTP. I'll just read out the question and I'll solve that question for you, so that it is easier for us to understand the logic of this adjustment. I think that carries pretty good quantum of adjustments, and it will be easy for us to understand the logic that we have discussed so far. So this question number 6 from your RTP, I'll solve it for you. You can go back and you can refer to the question if at all you want, if you don't have it as such. Okay. Now, here there is a question which says a trader prepares his accounts on 31st March every year. So let me draw a timeline. On 31st March of every year, the trader is preparing his accounts. Due to some unavoidable reasons, no stock taking could be possible till 15th of April. So when did it happen? It happened on 15th of April. Then on that date, the cost of goods in his godown came to 50,000. So here the cost of inventory came to 50,000. Now this is actually physically verified and counted. Now during this period, the following facts were established. That is between 31st March to 15th of April. Sales of 41,000, including cash sales of 1,000. We will see what is the adjustment needed here. Cash sales of 10,000. Then purchases of 5,034, including cash purchases of 1,990. Sales return 1000. Then on 15th March, now on 15th March something happened. What happened on 15th March? Goods of the value 10,000 were sent on sale or return basis. So goods sent on sale or return basis 10,000. Then the period of approval was 4 weeks. What is the period of approval? 4 weeks. Means from 15th March you will count 4 weeks plus 7 days plus 7 days plus 7 days and another 7 days. So 4 weeks are allowed, obviously, which means this falls in this financial period. He returned 40% of the goods on 10th of April. So what happened? Somewhere on 10th of April, this guy returned 40% goods. So out of this sent, 40% is returned. Okay. Approving the rest. So balance was what happened for the balance? For the balance, 60% approval was given. And the customer was billed on 16th April. So billing happened on 16th April. Now look at this adjustment. This 16th April, whatever happened, that billing, that would not form part of this sales. So now we have to understand what is the impact. Okay. Then the trader also received goods costing 8,000 in March for sale on consignment basis. Now what happened here? In March, so they have not specified the date. So let us take any date in March. The trader received goods costing, so he is now a consignee. As a consignee, he got goods worth 8,000. He got goods worth 8,000 on sale on consignment basis. Now out of this 8,000, 20% were sold by this date. 20% were sold by this date and another 50% by 15th of April. So %50 sold by 15th of April, and these are not included in the sales. So this 41,000 of sales does not include these consignment goods which have been sold. And the goods are sold by the trader at a profit of 20% on sale. So basically whatever the trader does, he gets a gross profit of 20%. Now this example has a typical combination of consignment where the person is a consignee and there is goods which this person has sent on sale or return basis. Now let us see how do we solve this particular problem. To begin with, what was the cost of inventory? First you will write it down. Cost of inventory on 15th of April is 50,000. Cost of inventory on 15th of April is 50,000. Now we have to do adjustments. What is the adjustment? We have to come back from 15th of April. We have to come back from 15th of April to 31st of March, which means if any sale has happened, you have to add it back. If any purchases has happened, you have to reduce it. The sales return treatment will be exactly opposite. Okay, and we know the gross profit that has happened. Now, if 15th April, the inventory is 50,000. Now, what I need to do is I have to go back and check how much of sales I have made. Now, for that sales, I have to reduce or I have to add. I have to add that because when I made the sales, the inventory would have come down. When I made the sales, inventory would have come down. Now, when I'm working back, I have to add it. What is the sales figure? Sales figure is given as 41,000 and sales return is 1,000. So net sales of 40,000. So make that first adjustment. Cost of goods sold. Cost of goods sold. Now, cost of goods sold, how do we compute that? 40,000 is the cost. Sorry, 40,000 is the sales value. 20% is the cost, gross profit. What will be the cost? Cost will be 80%. So 20,000 multiplied by 80%. Sorry, 40,000 multiplied by 80%, 32,000. This we will add back. Why will we add back? Because we had sold it. We had sold it. When we sold it, the inventory had come down. Now, when we are going back, we need to add it. So, this is the first adjustment that we have to do. Then, second adjustment we have to do for purchases. So, what is the purchases number? Purchases amount has been given as 5034 and this will be at cost. We don't need to do any other adjustment for this. So, purchases 5034. What will we do here? We will reduce this amount. Now, why will we reduce this? We will reduce this because when we purchased, we have increased the value of inventory. Now, because we have sold, we will reduce it, right? So, we have 50,000 of cost of inventory, cost of goods sold 32,000, which we need to add, and then 5,034 we need to deduct. Then, when we did this inventory take, when we did this inventory, what did we do? 50,000 is the cost. Now, this would also include inventory that we have received on consignment basis, right? We said that we have received goods on consignment of 8,000, out of which 20% was sold by 31st of March and 50% was sold by 15th April, which means we still have 30% of the goods with us. We still have 30% of goods with us, and that would be included here. When we did the physical verification, it would have been included here. Now, when we have to calculate our inventory, we have to reduce this. So, minus goods held as consignee. Goods held as consignee. How much is left? 30% of 8,000. That comes to 2,400. So these are the two numbers that we need to reduce. Now, coming back to the last adjustment, we had sent certain goods on approval basis. We had sent certain goods on approval basis. How much was that? 10,000 was the goods which were sent on approval basis. And what is the approval period? 4 weeks, which means as on 31st of March, because we have not yet received any intimation. When did we receive the intimation? We received the intimation on 10th of April, right? Now, the returning and sale, whatever happened, that happened in the next period, which is in this particular, on this particular date. Did I read it correctly? Was it 10th of April? Yeah. So, 10th of April was the confirmation and 16th was the billing. Now, this purely means that this entire goods which were sent on approval or return basis was our inventory as on 31st of March. This was our inventory on 31st of March. Right? Now, when did he return the goods? He returned 40% of the goods. Please understand this adjustment very carefully. He returned 40% of the goods on 10th of April, which means this 50,000 already includes that. This 50,000 already includes this 40% which has been returned. Now, is it our inventory on 15th April? Is this 40% our inventory on 15th April? Yes. Is it supposed to be inventory on 31st of March? Yes. So, to the extent of 40%, we do not need any adjustment. I am repeating once again, 40% goods were returned on 10th of April. This 40% which is returned on 10th of April is included in this 50,000. Now, is it our inventory on 15th April? Yes. Is it our inventory on 31st March? Yes. And hence, there is no adjustment required. Now, for which amount we need the adjustment? 60% amount. Because 60% is not yet returned back. This 60% is not included in this 50,000. So, for this 60% of the goods, I need to add it to my inventory. So, let me add that. Goods on sale or return basis, 60% of 10,000. 60% of 10,000. Of this, we'll only consider the cost. What is our cost? 80%. So 60 into 10,000 is 6,000. Multiplied by 80%, we get 4,800. you do the total, you will get the inventory valuation. If anyone has any doubt in the treatments that we have done, please let me know, because by solving this, we have covered both as a consignee and on sale or return basis as well. Sales is 41,000, but then there is a sale return of 1,000. Please understand, please note the question. Sale of 41 minus sale return of 1,000, so net sales is only 40,000. Right? You can do the calculation and you can figure out. Now, another typical type of question what comes in the examination is, they will tell you purchases are, let us say, 1 lakh. Purchases are 1 lakh. Purchases are 1 lakh and sales are, let us say, 80,000. Sales are 80,000. Inventory at selling price, let us say, is 40,000. So they'll give you purchases, they will give you sales, and they will give you inventory at selling price. You need to find cost of inventory. You need to find out the cost of inventory. Now, how do we find out the cost of inventory? Always see, whenever we prepare a trading account, you have opening stock here. Okay, in this case, we don't have opening stock. You have purchases here, right? You have sales here, and you have closing stock at cost here. And whatever balance comes becomes your gross profit. Okay. Now, when we do not know what is the gross profit value or what is the gross profit ratio, what we can do is we can see what is the sales, what is the closing stock at selling price. Basically trying to figure out, if we sell this product, what is the value that we will get? What is the estimated sales value of this particular closing stock? Now with this two, we get the total sales value. Means sales already done and sales expected to be done. We get the total sales value. On this side, we'll get the total cost. Balance will be our gross profit. Now, we're using similar logic. Here, 1 lakh is my cost. This is my cost. Both of these put together is my sale value. So cost is 1 lakh. Sale value is 1,20,000. So sale value is 1,20,000. Cost is 1 lakh. What is my gross profit? Gross profit is 20,000. My gross profit is 20,000. Now I can find out what is my gross profit ratio. That will be 20,000 divided by 1,20,000 multiplied by 100, right? So this comes to 200 by 12, which is 16.67%, right? Now with this gross profit ratio, I know sale value of inventory is equal to 20,000. Gross profit is 16.67% of 20,000. So 20,000 multiplied by 16.67%, that is 3334. And cost will be 20,000 minus 3334, that is nothing but 16,666, right? So this is another kind of question which is asked in the examination. There is a question. Okay, so let me just, I think there are some good questions on the problem that I've solved just now. One, they are saying, one you mentioned that sales is 41,000. I'm repeating once again that sales is 41,000, but there is also sale return. Sales are 41,000 and sale return is 1,000. So the net sales will be 40,000. Net sales will be 40,000. That is one thing. Then Amol, this lecture doesn't happen every day. 2 days back, we had a session, and based on this, based on the students' question, I'm covering few more topics. Now, there is another question which says why you took 80% in the question. Now, here, please see, this gross profit ratio is given as 20%. The question says gross profit ratio is 20%. Now, because gross profit ratio is 20%, if I have to calculate the cost, I will use 80%. So always remember this, and though it's a simple topic, it's good to revise. Sales minus cost of goods sold is gross profit. If gross profit is 20%, sales is at 100%, my cost of goods sold will be 80%, or my cost of goods will be 80%. I will always value the inventory at cost. That is why I have considered 80%. See, why 60% should be added? Very good question, Ananta Krishnan. Why it should be added is, if we come back to this question, what did the customer do? We sent 10,000 worth of goods to the customer. So understand this. We sent 10,000 worth of goods to the customer. Out of this, he returned 40%. He did not return 60%. This was returned, and hence this was included in 50K. This was already included in 50K. Okay. The balance 60%, it is still with the customer. The customer did not return. So this is not included in 50,000. But is this my inventory on 31st of March? The answer to that is yes. It is my inventory on 31st of March. That is why I have to consider only 60%. Because 60% the customer has not returned, he has returned only 40%. And we have taken physical inventory in our godown, not at the customer premises. Okay, I hope the doubt is clear. Okay. Account current, I don't think time will permit because I have considered joint life policy, right? If you have any specific doubt on account current, any specific question where you have a doubt on account current, you can let me know at our forum section. I'll be happy to help you there with a written response. Okay. But today we thought we'll come based on the students' feedback, the inventory and joint life policy. Earlier we did some provisions and adjustments for final accounts and for consignment. Okay. Now coming to joint life policy. So one thing is, you need to understand what is the concept behind joint life policy. Why do we take joint life policy? Now generally what happens is, whenever there are 2 or more partners working in a firm, and if at all, let us say one of the partner dies, there may be a need of capital requirement because you will have to pay back the the legal heirs of the partner who has died. For that purpose, generally firms tend to take joint life policy. The name itself says joint. It is in the joint name of, let us say, 3 partners, A, B, and C. Now, if any of the partner dies, then the entire value of the policy is received by the firm. This is the concept behind joint life policy. Now, every year what happens is, you need to pay premium. You need to pay premium. Every year, the firm will need to pay premium, and at the maturity or at the death of the partner, the firm will get back the money. Now, there is another concept you need to understand, something called surrender value. Now, what is this surrender value? Let me draw a timeline. This is, let us say, year 1, and this policy is for 10 years, year 10. Year 2, 3, 4, and so on till 10 years, premium needs to be paid. Every year you need to pay premium. So let us say premium is 10,000. Here also you pay 10,000. Here also you pay 10,000. Here also you pay 10,000. So on and so forth. You pay till 10 years. And let us say the policy after it matures is worth, whenever it is matured or whenever someone dies, it covers for 2 lakhs. Just for our example purpose. Okay, it covers the partnership firm for 2 lakhs. So even if let's say a partner dies in year 3, entire 2 lakh will be paid by the insurance company to the firm. Okay, now it may so happen that sometimes the firm may decide to discontinue this policy. The firm may decide to discontinue this policy. Now, if you discontinue, let us say you paid premium for year 1, year 2, year 3, and year 4, and in year 5, you want to discontinue this policy. Now, when you discontinue this policy, how much premium have you paid? 40,000 is already paid, right? Now, if 40,000 of premium is already paid, and if you want to surrender this policy, depending on the bonus schedule provided by the life insurance company, they will have something called a surrender value. Now, surrender means what? In 5th year, I told the insurance company, I don't want your policy. Take your policy back. Give me whatever I am entitled to. Give me whatever I am entitled to. I'll happily take that money and I'll be done with this. I don't want to continue with this policy. Now, also remember, this kind of surrender happens only in case of an endowment policy. It doesn't happen in case of a term insurance, right? So, if it is a term insurance, you will not get anything. But if it is an endowment policy, you will get some money back. Now, every year, the insurance company will tell you, if you surrender this policy on year 1, you will get, let us say, 2,000. In year 1, if you surrender, you will get only 2,000 back. In year 2, if you surrender, let us say you will get total of 10,000. Now, how do you need to understand this? You need to understand this, that you have paid 10,000 and 10,000, but you will get only 10,000 back in return if at all you surrender that policy. So like this, every year surrender value is given. Now, depending on the accounting treatment that you follow, you will have to consider the surrender value. Now, there are 2 ways to account for joint life. Actually, 3 ways to account for. Second and third method are pretty similar. So there are 2 ways to account. First, we'll understand the 2 methods, and then we'll add the joint life policy reserve system. First is directly debit to P&L. How much did we pay in year 1? 10,000. So you say joint life policy premium 10,000 to bank, $10,000. Just a second. I think this pencil is troubling. Give me a minute. Just. Joint life policy premium 10,000 to bank 10,000. This is the first entry. Then what will be the next entry? You will transfer this to P&L. P&L debit 10,000 to bank 10,000, right? Now, when you do this, what happens? The joint life policy premium that you have paid is actually expense. There will be no asset in the balance sheet. There will be no asset in the balance sheet. Now, assume you do this for 2 years. So, in every year, the amount is expense. There is nothing in the balance sheet. Whenever you receive the money from the insurance company, say for example, you surrendered it after 2 years. After 2 years, you receive 10,000. Okay. Then what will you do? When you receive the money back, you would simply do bank to joint life policy account. Let us say you receive 10,000. Bank to joint life policy account 10,000, and this joint life policy balance, whatever is there, will be distributed to the partners in their profit sharing ratio. So joint life policy to partners in their profit sharing ratio. Okay, this is the first method to account for it. In the second method, I think there is some problem with iPad. Just give me a moment. So under the first method, what do we do? Whenever we pay, we say JLP premium to bank 10,000, 10,000, right? And whenever, and then what we do, we'll transfer this to PNL to JLP, joint life policy premium. Don't write shortcuts in the examination. And whenever you receive money, you debit bank and you credit the joint life policy account. And then whatever is the balance in joint life policy, you transfer it to the partners in their profit sharing ratio. This is the first method. Now in the second method, what we do is we treat it as an asset. Why do we treat it as an asset? Because in the future, you will receive some benefit from this joint life policy, either the surrender value or the, at the time of death, the insurance policy value. Now, whenever you treat it as an asset, the premium will be debited to JLP asset account. JLP asset 10,000 to bank 10,000. Now assume at the end of the first year, the surrender value of this policy is 5,000. How much is the surrender value? 5,000. How much did we pay? 10,000. Asset is at 10,000. How much is the value now? When I say surrender value, if you go and surrender the policy on 31st of March of that year, you will get 5,000. Now, when you do that, what will the entry you pass? You will debit the balance, that is difference of 5,000 to PNL, or assume surrender value is 2,000, which means this asset is not worth 10,000. This asset is worth only 2,000. So you will debit the PNL account by 8,000. You will credit the JLP asset account by 8,000. Now with this, what will happen? The joint life policy asset value will now be seen as 2,000, which is the surrender value. Now, what happens when the policy gets matured? Whenever the policy gets matured, whatever is the amount. So, let us say you have a JLP account here. Okay, to bank 10,000 by PNL 8,000. What is the balance then? By balance 2,000. Okay. Now next year it will be to balance brought down 2,000. Again, you will have the same entry to bank 10,000. Then let us say surrender value. Surrender value at the end of the second year is 15,000. It may not increase by so much. So let us say it is 10,000. So here you will have by PNL 2,000. Okay. Now let us say in the third year, one partner died. To balance 10,000. In the third year, the partner died. Now, when the partner died, what happened? The insurance company paid you the entire amount. You will get by bank. Let us say 1 lakh is the policy term. Okay, so you will get 1 lakh. Now, 10,000 was the surrender value. You got 1 lakh. The balance will be transferred to the partners in their profit sharing ratio. This is how you treat the joint life policy account. Now, the third method is using a reserve, joint life policy reserve account. Now, similar method, what you do is, instead of crediting this amount, debiting this amount of 8,000 to PNL, you will first create a joint life policy reserve. So, you will create an account called JLP reserve account. Here, every year, you will get money from the PNL appropriation account. What is the value that will take from the PNL appropriation? 10,000, the amount of premium. And this amount, the joint life policy amount, whatever is the difference, means surrender value between the asset and the surrender value, this 8,000, that you will not transfer to PNL, you will transfer to JLP account. So this will not be PNL, this will now be JLP account, JLP reserve account, right? And in JLP reserve, you will have an entry to joint life policy asset account 8,000. Now, once you do this, you will have a reserve of 2,000 and you will have a asset of 2,000. Both of these will be carried at surrender value. And when the policy gets matured, whatever is the amount in the reserve account, that to transfer to JLP asset account, and whatever is the balance left out in the JLP asset account, you will transfer to the partners in their profit sharing ratio. Right? Any doubt in this joint life policy? What is the specific doubt? Okay, let me just. See guys, the question about Bharat Bandh and all, I don't think that will impact your examination. Generally, these Bharat Bandhs and all are not successful across the country. So depending on the state and all, maybe institute will give a call. You need not draw with pencil, you can draw with pen also. In fact, I have not drawn the formats in some of my papers. I used to just fold the paper and I used to write my answers. That's not a problem. Third method, okay. So in the third method, I'll just do the third method once again. You have JLP asset account to bank 10,000. Then you will create a JLP reserve account by P&L appropriation 10,000. Okay. Now whatever is the balance, let us say at the end of the first year balance is 2,000. Balance is 2,000. Then what would you do? In the second method, you will transfer this to P&L 8,000. But under the third method, you will transfer this to JLP reserve account. So here, in the JLP reserve account, you will have two JLP asset account 8,000 and to balance 2,000. So in this case, what will happen is there will be an asset of 2,000 and there will be a reserve of 2,000. Both will be carried at the same value. Now, when the policy is closed, you will transfer the reserve balance to the asset account. So let's say policy is closed in the next year. In the next year to balance 2,000. And this year the policy is closed and you got, let us say, 5,000 for example. So by bank 5,000. Whatever is the reserve here you will have by balance 2,000. Now this balance you will transfer to JLP asset account. That is 2,000. So here you will get by JLP reserve 2,000, right? Now whatever is the balance, 2,000 debit, 5,000 credit, 2,000 credit. This 5,000 will be distributed to the partners in the profit sharing ratio. I hope the third method is also clear now. Right, the entry can be both. So you can have, so it can be JLP premium to bank and then P&L to JLP premium, or you can directly say P&L to bank, up to you. Okay. Any specific questions you have in these two topics that we have discussed today, that is on inventory valuation and on the joint life policy, you can ask me. Any other questions you have? I don't think it is advisable to have another live session given that your exams will begin from 8th, that is on Tuesday. If you have any question, what I suggest is you can come to our forums and you can ask there. We'll be happy to help you with any doubts you have. Okay. 2 days now, I think this is the time you start focusing on your accounting paper, start preparing for your accounting paper, and stay calm in your examinations. If the due date is on Sunday, but see, Anantha Krishnan, you will not be able to figure out if the due date is on a Sunday or not, given if they give you some other calendar. So don't waste your time in computing that. If they tell that this particular day is a Sunday, then you take a previous day. If they do not tell anything, assume that it's a normal working day. Because if they give you 2017 or 2018, how will you go back and check what is the date? So the best thing is to assume that it is a working day. If they tell that a specific day was a Sunday, you have to take the previous day on average due date. Yeah, if it is given, you have to consider. If it is given specifically that this day was a Sunday, then you have to take it a day previous to it. If it was an emergency holiday, you will have to take the day after that. And in some of the problems in average due date and all, if they give you bills, then you have to add 3 grace days. If they don't give you bills, if they give you normal debtor and creditor, you will not add 3 grace days. In one of the questions in the institutes, I think RTP or somewhere, they have added 3 grace days in case of a normal debtor and creditor. That is not correct. Okay. NPO. It's too late for us to do anything on NPO, right? See, you can, so Lakshmi, you can, we don't have a plan for a video on NPO, but you can check out individual modules on our website on not-profit organization. You can, revise using that. Answers can be in, see, as far as inventory calculation and all is concerned, just make sure that you start with the inventory, have the adding items together, have the deducting items together, and then you calculate the cost of inventory. Till the time your entries are fine, that should be proper. There should not be any issue. Right, so I think no more questions here. Guru, so there are nothing called as important questions. Just before your examinations, the best thing you can do is revise the last 3-4 attempts of question papers and RTPs. That will give you a very good sense of what kind of questions can be tested in the examination. No, there is no particular format on the question, so you can do as per your convenient format. That is perfectly fine, right? Have a nice time. Stay safe, stay calm. For many of you, you are writing a professional examination for the first time, but don't be scared. Think as if you are writing the next level of examination. After 12th, you are writing one more examination, right? Go with that attitude and do well in your examination. Yes, and one more thing last before I wind up. The true and false questions, don't forget to write reasons for that. Okay. So yes, there will be a lot of stress for the first timers that you have never faced a professional examination prior to this, but take it as any other ordinary examination. Don't think that it is a very tough examination. It will be very difficult to crack. You are prepared well, do well. Even if you do 80 to 90 marks properly, getting 55 to 60 marks should not be a challenge, right? And I have mentioned in my earlier videos also, for final accounts related problem, don't think that if the balance sheet doesn't tally, you will lose the entire marks. You can do whatever you can do in the given limited time that is available, right? All the best and write your exams properly. Thank you.